Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is certified financial planner and registered investment advisor, Rob Odell. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're talking about the basic definitions of tax planning to give you some tools for your end of the year appointments with clients and prospects. We're also going to compare and contrast AGI and MAGI, all from Rob's popular Mind Map seminar series. Well, welcome to the show. I'd really love to have you back. I haven't seen you in a year.
I know, it's been about a year. Good to be back.
Let's talk about some of the things that we're going to be bringing up for end of the year. But I love this idea of laying down some definitions first.
Absolutely.
Because, people go, well, what's AGI? What's MAGI? Is an exemption worth more than a deduction or a tax credit?
Well, let's get started. Before we get into AGI and MAGI, let's talk about the line, the infamous line, above the line, below the line deductions. This is very important. So if you look at the front page of a 1040 and you go to the bottom right, that's your adjusted gross income. Any deduction before that is above the line. That's where the line is. Any deduction after the AGI in the second page, that's below the line. It's very important to understand the difference between above the line and below the line deductions. Now, let's talk about AGI and MAGI. Income, you have income less certain adjustments, an IRA contribution, self-employment income, or health insurance deductions. These are all deductions that are above the line.
So it's going to be on page one.
Right. Now, when you talk about MAGI is AGI, but you add back certain things in, such as muni bond interest, deductible IRA deductibility, and Obamacare is very big components of MAGI. Let me give a chart up here. So let's talk about fiscal cliffs here and various lines that we're always looking at in tax planning. First thing you have is the Obamacare, which is the health care reform. This deals with modified adjusted gross income, MAGI. So if you're a head of house or single, $200,000 is when that 3.8% tax starts to kick in. Married filed jointly, $250,000. Married filed separately is $125,000. So that's one line. So that's the bottom right of your 1040. Now, there's phase outs that came back to us in 2013 that dealt with that phase out different benefits you get on the Schedule A. And so at various levels where itemized deductions and personal exemptions are phased out is for head of households, it's $275, single $250, married file jointly is $300, and $150 separately.
So once you cross these lines, personal exemptions for you and your wife are probably gone if you're filing jointly. Exemptions maybe for your children.
Not necessarily gone, but they're phased out.
They're phased out. So it might be less.
It might be less.
Now
correct.
you might have a mortgage interest could be less.
Yes, exactly.
Okay, so there's areas here that if we start getting up and we're talking about the Obamacare imposition, at not only, I'm thinking of capital gains, you could be paying 20% plus his 3.8% Obamacare on just cap gain issues.
That is correct. And where that kicks in at different income levels is that, let's talk about higher capital gain rates and qualified dividends. So right now at the federal level, it's 15%. But once you cross a threshold of these numbers right here for the various categories, it goes up to 20%. So you could have a 15% ordinary, normally a capital gain being taxed at 23.8 because it's 20% here plus the 3.8 thanks to the Obamacare.
Okay, so deductions, so the big thing you're saying, and this is why we want to make sure that our advisors are understanding this is all on page one, above the line, adjusted gross income.
Correct.
Okay, but when we turn to page two, now we're talking about modified adjusted gross income, and there's about 3 or 4 iterations of this, so it's not all straight.
It's complicated stuff. It really is. It's very complicated. So some of the terms you talk about here, you're kind of hitting on there, Steve, is exemptions, which reduces personal and taxable income. There's restrictions. These restrictions are like a deduction. It's like a stealth tax, if you wish, that comes into play here. Various deductions on Schedule A, very big ones, are mortgage interest, charitable gifts, which we're going to talk about in later shows here. Taxes, state income taxes, real estate taxes that you pay, medical expenses, and this is a big one. What's interesting, I live in Naples, Florida, and in Naples, Florida, continuing care facilities are very popular, where someone will come in, they'll buy a condominium, they'll have a full scale. Well, the year in which they move in and write their big down payment, for that which they do not get back, meaning what the institution keeps, they get a sizable income tax deduction as a medical expense. Now, we really got to monitor their income because it could be phased out if they make too much income. Then there's some people with the standard deduction. This is something where if you do not have high enough Schedule A incomes, you claim the standard. And so for individuals who are claiming the standard, whose clients are claiming the standard, you might want to do something called leapfrogging. Let's say they're charitably, they give to their local church. We might have them pay 4 years in advance of charitable gifts to the church and then claim the standard deduction thereafter. So get a large Schedule A deduction, and then years after that, take the standard. And then credits, love credits. Credits reduce tax liability. A deduction reduces taxable income. Credits reduce your tax liability. The famous one is the energy credit. You buy a car that's electric, you'll get a credit up to $7,500. The child tax credits, and there's adoption credits. So credits I love tax credits. Those are excellent things.
Now, the tax credits are used directly for taxes owed.
Dollar for dollar reduction of what you owe in income taxes.
So those are huge.
Those are huge.
Okay.
Those are huge.
Okay, so now we're talking about exemptions, deductions, and credits. We got to know that going in.
These are 101 things.
We got to know above the line, AGI, below
Correct.
the line, we're talking modified adjusted gross.
Correct.
Okay, so for the more affluent clients, we may have phase outs or eliminations altogether, depending upon if they cross those tiers that you were talking about.
And yeah, absolutely. And then there's something called alternative minimum tax, and that's a stealth tax. And sometimes those will wipe out deductions altogether, often in the medical or advisor fee deductions, which is a real big one. I have clients where they're paying their advisors $20,000, $30,000 a year, and they're putting it on their Schedule A, but no benefit there.
Now, a couple years back, they actually brought us into the 21st century. The AMT finally got there. It's actually reflecting the income, the middle class.
Well, they indexed it. They didn't index it. They introduced it, I think, in 1969, and they never indexed it. Well, thanks to what we're going to talk about next, the act that was passed in 2012, they brought some indexes as well as some other things into it. So we'll talk about that next segment.
Well, for more information on end-of-the-year planning ideas, just click on the landing page address in the video description. We'll be right back with more from Rob O'Dell.
A solid web presence has never been more important to the success of your business. Introducing Agent Website Creator, provided by CreativeOne. Through Agent Website Creator, you can create your own personalized website and have it up and running easily with zero knowledge of programming. Choose from several designs with easy drag and drop customization. Get proven lead generation offers, professionally written articles, and helpful financial calculators. Plus, the ability to embed videos, integrate your social media, and more. Update your website anytime and show the world within minutes. The best part? It's hosted for free. To learn more about Agent Website Creator, call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, we're talking about the American Taxpayer Relief Act of 2012 to help you with your end-of-the-year appointments with clients and prospects, all from Rob's popular Mind Map seminar series. Well, let's talk about this act. Now, this is about the biggest legislation we've had in recent times.
Yeah, in the last decade,
But it's been impactful.
Right, very.
So let's talk about
much.
that.
Well, it's interesting when they passed this. I remember at the end of 2012, we were waiting for the legislation to pass, and we like to tell people this act was actually passed on December 32nd of 2012, also known as January 2nd. It was passed when it came into being. So I remember waiting, going through New Year's, and seeing what was going to happen. So it did a lot of things from a tax perspective for us planners that we need to be looking at and understanding for our clients. First thing it did, it permanently ended the Bush tax cuts. It sunsetted them, jettisoned them all, because they were supposed to end in 2010, but then they extended them 2 years into 2012. And then it created a 7-bracket income tax, 7 brackets for ordinary income. And this is where it came in, and it's in existence for today. But what's interesting, it brought the marriage penalty back in. And if you look at the 25% bracket, if you're single or you're married, it's basically 2 times what a single would pay. However, when you get to the 28 and keep going beyond, it's actually more beneficial to be filing 2 singles versus married jointly. This is where the marriage penalty kicks in here.
Now, this is so funny because in the early 80s, we did the Marital Deduction Act for estate planning and all this in trying to encourage marriage. And now it sounds like from an economic point of view, we're not doing that any longer.
No. After 20, if you make too much money, be single. And I'm saying that tongue in cheek. This was really kind of funny, or I shouldn't say funny, sad, a commentary of Washington. They brought in the charitable IRA rollover for 2012 and 13. Well, as January 2nd was signed in. So they gave people the opportunity, if they made gifts from their IRA, to claim it up to January 31st, which is kind of crazy how Washington works. Then it brought in some stealth tax, so they reintroduced them. Part of the Bush tax cut is that they phased out the PEP and the Ps. This is reductions of benefits off the Schedule A. And if you make a lot of income, all of a sudden you limit the amount of deduction that you can take. They reintroduced that. So it's a stealth tax that came in. And then what we talked about in the last segment was the net investment tax was introduced. This is the 3.8, and as you said, it's really with another 0.9 on it.
Right.
So They introduced a net investment tax for people who make more money and they did not index it. So if you're single, making $200,000, or you're married, $250,000, they're going to tax investment income such as dividends, capital gains, interest. All those type of income that you make, taxable income, is now taxed with an additional
people have been
almost 4%.
talking about this because in the last 2 months, people are saying, hey, Steve, I noticed in my W-2 from my employer for affluent clients, there all of a sudden there's another new deduction line coming out because of this 3.8%.
Right, and they based it off MAGI, which is modified adjusted gross income. So if someone has lots of municipal bond income, that is brought back into the calculation. They're not taxed on it, but it raises their income so that other taxable income and investment income is taxed.
Unbelievable. So even though the muni bond itself isn't getting 3.8%, it causes other income to actually attract 3.8%, and that's taxed on top.
That is correct. Yeah. That is correct.
That is stealth, by the way.
Yeah. A couple of things that it did do is it tied qualified dividends to long-term capital gain rates for people who are not in the highest, or I should say it's for everybody. But this is, so if someone has a qualified dividend and if they're under the highest tax bracket, they would pay 15% on the federal. However, if you're in the 39.6, you're paying 20% long-term capital gains and qualified dividends.
Well, is this going to be a war zone when we think about where we have a marginal progressive tax bracket?
Right.
And now we're trying to look at brackets, trying to keep our client at the lower brackets. There could be this bracket bumping going on where people say, I was okay on my ordinary income tax, but I'm getting hurt by this 3.8
Exactly
Obamacare
right.
tax.
And this time of year, which is we're in the fourth quarter, and my team are spending time doing income tax planning. The last thing we want is a surprise when they file their income tax returns. So we're looking at their adjusted gross income, their MAGI, their taxable income, and then also their itemized deductions. And we're trying to engineer the tax return. So we might have clients accelerating some gain. We might have clients taking extra from their IRA. Various things so we can engineer the tax return for this year, 2015, and also looking at 2016 and 2017.
Before I let you go on, do you do a lot of tax harvesting of your non-qualified ETFs and or mutual funds?
We do. And so we look at that. So if we have someone, let's say, for instance, a big one is the kiddie tax, which has really been a lot of quiet work on the kiddie tax, taking the benefits away. But for instance, I have a client whose daughter is 26 years old and in grad school, making next no income because she's not out of grad school yet. We can gift over to her low basis stocks and sell it, and she would not pay capital gains because she's in the lowest bracket. So we're doing all sorts of harvesting gains, taking distributions from annuities, from IRAs.
And you just brought up one that has nothing to do with taking losses and gains on one balance sheet issue.
Correct.
You're talking about the gifting issue.
Right.
So there's a lot of things to play. I just want to encourage our audience, especially if you're a registered investment advisor or security licensed, playing this time of the year on the tax issue. If you're not up to speed on 1040, this is why we're doing the show. This could be huge for your practice.
And I might just say, if you have an expertise or get an expertise in tax planning, your clients will love it because they love the immediate gratification of knowing that they're going to pay less income taxes. Clients love it, and so we do it every year with them, sit down with them, and plan their taxes.
Well, for more information on the American Taxpayer Relief Act of 2012, just click on the landing page address in the video description. And for more information on all our shows, seminars, and workshops, just follow us out on social media or visit us out on our website. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.